Hello, my name is Dr. DrMochocki, and welcome to a series we're taking an introduction to business. This week we're going to be covering Chapter 19, which is securities market. When you look at securities market, it basically takes care of securities, any kind of instruments that we like bonds, stocks, all that falls underneath what we would consider the security market. Okay, so we talked about chapter 18, we already talked about a little bit about accounting. So this is the next step from the to financial market to understand functions of security market. So open up your mind maps. Okay, and we're going to go into function of security markets as long-term funding for business, place to buy and sell securities, investment as bonds, securities, everything else, anything, any kind of investments that I am looking at a return on my investment. I buy and sell it through the securities market. What are some capital markets? You have primary markets. Initial public offering is the first time that a company is offering stocks for either reinvestment or the first time a new corporation, when you open up a new corporation that's selling stock, like you had Facebook or you had Twitter that's selling stock, the first time they're selling this, what they call initial public offering. The initial public offering means that the money that they're selling, the stocks that they're issuing, are basically going to come back to the organization. It's like when I buy a brand new Corvette or buy a brand new car, a Toyota, whatever. When I buy that car, the money goes back to the manufacturer, the Toyota, because that's their initial public offering. This is a car. Then you have the secondary market. When I had the secondary market, is now I've had the Toyota or the Corvette or whatever car, and now I'm going to sell it to somebody else. Sometimes because of the depreciation, the car is worth less, or sometimes it appreciates, like the Corvette, when they appreciate depending on what happened that year with that Corvette. Did it win some kind of a race or something else that made it a classic for that year? So the value would depreciate. And then now when I sell that as in the secondary market, it's no longer going to General Motors or Toyota or whatever. It's going to me, the owner. So remember, the initial public offering, the money goes back to the corporation. Now the corporation like Motorola or something, or Baxter or Abbott or AT&T or Verizon, whatever, and now they need more money. So they could issue stocks again. If you learned from previous chapters that a corporation, not an S corporation, but a regular corporation, a standard corporation, has perpetual life and could issue stocks going forward. It means it brings more owners in as the organization is growing. So now that I could issue stocks again, I'm issuing the stocks because I need money. And if I need money, then it's an initial public offering because it's going to come back to me. And the reason I'll have that in my yearly end report is annual report is to tell the stockholders that's why you're not getting any dividends, because I'm taking I need money to open up a new venture in China or in South Africa or in Africa or in the Middle East, wherever, and that's what I'm going to reinvest that money. But I need not only reinvesting the dividends I would give to you, I also need more capital. And instead of taking a loan out, I'm going to offer more stock. So again, I'm an initial public offering. Initial public offering, money goes to the corporation. Secondary market, money goes back to the investors. Okay? Makes sense? So you have those two. It's not bad once you understand the concept, but make sure you understand. Investment banker, he or she is the one that underwrites any kind of new stock purchases. Me as an individual into buying into securities market and trying to buy stock, I'm not sure if the company is really there. Is the stock of any value? Who does all that financial reporting? Not only what they say, but so an investor banker basically underwrites the stock, say, yes, these stocks are sound. Yes, there is capital. Yes, this is a real company. Yes, they are making this profitability. We've checked it through our auditing. And that's where you had a lot of the new rules and everything else coming in accounting, is because some of the investment bankers like JP Morgan or some of the other ones that were manipulating the stock market. They weren't exactly, they're underwriting stocks that they knew were weak, for lack of better words. They weren't AAA rating. They should have been classified as junk stock, but they're trying to sell it to the investor. So that's where you've seen the penalties and everything else that you see JP Morgan, or Chase Bank in the limelight right now. Okay, now bonds. If I look at bonds are different types of bonds. I'm not going to go into too much. I'm trying to get into this within 20 minutes. You have bonds is another way. I don't want to have. Remember, when I sell stocks, other than you get like the preferred stocks, which only pay for the dividends, and we found that in accounting. But if I sell stocks, it means I'm bringing more owners in. If I bring more owners in, that means I have more people to have to convince to have an input in how the organization is being shaped. But the other way I could do it instead of bringing more owners or in a personal thing, getting married or bringing a partner into my for me to get more capital, more money, I basically take a loan out, or I could issue bonds. Bonds is an IOU. It's what we call debt financing. The stock market and everything else comes selling is called capital financing. So debt financing is where I take a credit line or anything else, or I sell bonds. And now on the bond, you have coupon and interest rates. It's always posted on a bond. You know, the bonds are electronic. You don't see them anymore. You just get a number, or you have an account. But in the old days, you still have a bond, and sometimes you do have a paper bond for you to look at, but basically it's all done electronically. The same thing like you do with your checking and everything else. Most people checks are a thing of a past. You just use your debit card and you electronically are transferring funds. And the same thing with bond. Let's still be concerned about the terms and condition of the bond. You have the principles. The bonds are always in the denomination of 1,000. Maturity date. When is the bond? Full payment. It's not like an internal life. The bond keeps on going. It has a start date, it has an end date, and it has a return on the capital. And in that time, you can't touch the money that you put into the bonds, but you have to pay the interest to the individuals. And then when the bond comes to maturity, you finish paying off the interest. It means using the money, a usury fee, and you basically return the money that the person provided to you. It's kind of a line of a credit, only a little more formalized. Okay, maturity date, types of unsecured. Debenture is basically, I don't have anything on it, just my good words that you learn in the personal financing, the four C's of credit, and you're secured, or you have a mortgage behind there. Disadvantages, it puts the country issuing bonds, increases the debt. Remember, whether you like it or not, whether you have a charge card and everything else, you are you're just selling your rights. You belong to the person who holds the debt. So you're basically giving away some of your rights to the debtor. So when the company, if it happens to become dissolvent and is breaking up or going into bankruptcy, the stockholders, the last person, people that get paid, the bondholders, the creditors get paid first. Maybe it's 50 cents on a dollar, 25 cents on a dollar. Now, the other thing when you're buying the stocks and the bonds, be careful in terms of condition, because some companies, the current terms and conditions are stating, if we can't pay you back, what we do, we convert this bond into a stock. So now you are basically a stockholder, and that's not why you want to go into the bondholder. The bonds are the step style of the capital market, or the stocks and or stocks market. Buying them and selling stocks of organization. Bonds is just as much activity. It has a primary market as a secondary market. Just because I have an IOU for you and I need money, I could discount it to somebody else, and they just take over your debt. You just paid to somebody else. And I sold it because I needed the cash to, because I had a liquidity problem. So I sold the bond. I may get 20% interest that you're paying me. I say, hey, I'll sell you the bond for you only have to pay me 50% annuity over the compound what he would have paid me or whatever. But I need the cash right now, and he will pay you, or this company will pay you the difference. They'll still pay you at the 20%, but I'm getting 15% from you, so you're making 5%. So that's a secondary market. But the initial public market IPO for the bond, basically the money went to the organization who needed the loan. Okay, it's no different than a credit card. Sometimes you'll see your house, your mortgage, because the company is going under or is bought out. Now you've got a new mortgage payer. Your contract and the terms and conditions are the same, but basically just paying somebody else. Okay, so you got the bonds, and it tells you that types of bonds do you have on there. Corporate bonds are pretty good. As long as the corporation's name is well. Municipal bonds are pretty solid, but then you have what do you call Detroit's going bankruptcy. That's the first, because usually municipal bonds and government bonds fairly safe. They don't pay as much, but they're usually fairly secure. Okay, and debt versus equity. Debt secured, unsecured. On debt you have to pay the interest, and everything else must be repaid. And maturity bonds. These are the bonds. I'm sorry, and this is equity is basically the ownership. Investments can be preferred or common, not legally obligated to pay the dividends. Okay, so now you have that, the different types of stocks, common stocks, voting rights, everything else. Legal obligation does not create that. Ownership in a company, disadvantages. Your taxes are not tax deductible. The corporation, everything else will pay all the taxes just like a regular corporate citizen, but what you have to look at is after they pay all the taxes and everything else, because they are an entity in the eyes of the government, for lack of a better word. They don't vote, but they're an entity. They're taxed. They have all the same benefits as you as an individual citizen, so they pay all the taxes. And now when they have the profits, what's left, and they reinvest the profits to you, the stockholders, what we call dividends, you get those dividends. You have to show that again, that as income coming in, on your line, that this is interest that you earn from someplace else, return on your investment. So in reality, you're paying twice. The company's paying once, and you as a stockholder are again paying taxes on the profits, the small profits that you had depending on the shares that you own. And that'll never go away, because remember, the government, that's how to make them the money off the taxes. Okay, so that's common stock features, growth income, a blue chip versus penny. Blue chips are like the Motorola, the Ford company, the big ones that are sort of survived the economic downturn. And then the penny stocks, they're brand new. You have a lot of stocks coming out there and trying to sell, like coal stocks are dropping down a penny. Marijuana stocks are, for lack of a better, going up. A lot of people are legalizing marijuana for medical usage. So you have pharmaceutical companies buying in there, you have individuals buying in there. Will the company change? They're taking a gamble. They could lose everything. Also, federal regulations say, no, this is illegal. We're not going to make it. Or as you see more and more, the states are doing it because they're strapped for cash. So it's like a gambling or syntax. So they say, hey, they're already doing something like this. Let's go and we'll invest in this. And down the road, if the laws are in favor of legalization, whether it's an unlimited version, people who own stocks in that company, all of a sudden the penny stocks could be worth $100 instead of a penny. But you're taking a gamble. You could lose everything else. Blue chip on those stocks, less than $2. Market order, buy at the best prices. Normally, you buy stocks by 100 shares. I'll buy it by 100 shares, and I'll sell 99. I always keep to one share. Now I had the one share. I got to get the annual report, everything else, a proxy. I still have some value to it. Drives the companies, not just cost them more to send me all information, but I am a owner, even though I'm only own one share. But you normally have to buy it by lots of 100. Preferred stock, you pay dividends first. Remember, in business, if I give them something, I lose, I take something back. So I pay you dividends when there's dividends. And if I don't have any dividends because they're making profit that year or that quarter, the next quarter, or however I pay out the dividends, I have to, there are dividends in the rear, I have to pay them back first before I pay the stockholders any dividends. Because that's the ability is because I give up my voting rights. Now, here's what happens. You have a conversion, what they say in the stocks, and say the ability to convert. I could at any time, just like I would look at like take and say, here's my preferred stock. I want to be an owner because I see the growth instead of just income coming in. I can see the companies also growing. Remember, most companies, they either grow because the value of the house or the stock is going up, plus they're paying dividends, or the value is going up, no dividends, or no value is going up, but you're always paying dividends, or you have both. It's like buying a house. Do I buy a house and the only write-off I have is on my taxes, or do I buy a two-flat or a duplex that basically I live on the first floor and the second floor I rent out? So the first floor I pay taxes, second floor I can write everything off, the expenses, everything else, because it's considered a rental property. So I have different advantages, different tax brackets. So not only in the property grows, but I also get an income at the same time. So you have to look at stocks the same way. So dividends, par value, what the stocks is worth, and this is basically I need the par value. So when I pay the preferred stocks, I know what I paid. The par value or the preferred stock, when it's when you're paying on the dividends, it's worth on the value of the shares, not the market value, but the value of the initial public offering that has been established on there. And stocks, but if the market share, the stocks are going up real high, let's say a Motorola stocks are $200 a share, I want to go initial public offering. Most people don't want to spend $200 because they buy in bulk of 100. I may split the share, say every stockholder, you've got 200, or let's say 100, one share worth $100. I'll split it into in half, so now you have two shares worth $50, still 100. But now when I go out and do my initial public offering, I don't upset the market out there, and people are basically going to say, hey, that's a good value, and they're going to go in there and they're going to buy more shares at $50 than they would at $100 or $200. Okay, so you as a stockholder hold, you just have more potential for the company's growing. You just want to make sure they could market and sell it. Okay, organized securities, you have the New York Stock, bull market means the price is going up. Think of a bull market. Everything's going fast. Bear market, he's sleeping, but could be woken up. Okay, so the prices decline. New York stock is the largest American stock exchange. Over-the-counter stocks, not listed on the national exchange. NASDAQ is an over-the-counter stock. It's basically you see Google's, Facebook, anything else that is what do you call it? they don't have a real stock exchange, but they do have like a board and window so people could trade and everything else. And then when most of your online firms and everything else would be in the NASDAQ, National Association of Security Dealers automatic quotient, so you don't have to go in. It's a little less requirements than you would in New York, American Stock Exchange, because they're traditional. But if they're already listed in here, that's the only way you have to buy it is through them, and you can buy it through through the different brokers, or you can, there's other sites that we'll talk about later in the book how you as an individual could invest in that. Stock quotes that you're looking when people who have stocks, they don't have like 1,000 stocks, they may have like 5 or 10 stocks, and they're looking at the numbers at different ratios. They're looking high-low price. What's the high-low price? What did the price go up? Should I buy? Should I sell? And I'm looking over a year. Is this the highest? We went further than it's ever been in the last 5, 10 years. Some investors say it's time to get out, get my money, and invest it someplace else. Others say, hey, maybe I want to buy it now at the low price. So remember, it's the rich man's rich woman's gambling, for lack of better words, but you got to know when to buy and when to sell. Okay, and your PE ratio is profit to earning ratio, so number of shares sold. All of a sudden, the number of shares for the last 5 years were about, let's say, 1,000 shares within a month or whatever, 10,000, depending on the organization, and now all of a sudden 50,000 is selling. That's telling you something's going on. Either there's some new invention coming in with that stock, or there's going to be some deregulation, or companies going to belly up and people are getting rid of this stock. So the stock owner, do I want to buy it, and when do I buy it? Is it at the low price or is it at a high price? And I look at all these. So people who invest in stock, they look at these ratios, and these ratios will tell me the liquidity, the health, and everything else of where the stock is going by looking at the previous historical what do you call it, pass that the stocks went into. Then you got securities exchange, make say inside trader, make sure so that means you know something that somebody else does. That's why you're buying the stocks or selling the stock. That's illegal. Both and the government's looking at that. I bought for 5 to 10 stocks. I know something. They're looking at people who are buying the 10,000 stocks and bringing in $1 million or $2 million or $1 billion and getting rid of the stock. What did they know? And why did they know it before it was announced? Because once it's announced, then everyone else is either abandoning the ship or trying to get on there, but you had that edge, so that's illegal. Global Stocks Exchange, remember, just not only what we have, our own stock exchange, you have the New York Stock Exchange, foreign firms for 51 countries, you have the Euro, you have the NASDAQ, you have London Stock Exchange, Tokyo Stock Exchange. So there are other stock exchanges other than the United States in different cultures, but make sure they have different rules and regulations. They're similar. There's a global rules and regulation for all stocks being traded, but still individual countries have different rules or different conditions attached to what you can do. Brokerage fees, there's something to know. Warning, tax breakers, cheating, guarantees you losses. You can't guarantee. The market is open, so you never know. Types of investment. You have traditional stocks, bank, government, mutual bonds, real estate. Those are your traditional. Your high risk are your stocks on margin, junk bonds, and commodities are like oil. As the price is going up, it's going to go down, and you're basically betting on it and buying it now so you can sell it either at a discount or you're trying to get rid of it because you paid too much for it. Okay, so you're locked in on the prices. But these are all different. The high risk ones, you get a higher return, but there's a bigger risk that it may default not go. Your diversification, timeline, safety, income, and total returns, everything you should look at as when you look into securities, especially as an owner of mutual funds, the easiest ones to look at because somebody else is managing it and they're diversifying it as a company. Those are, if you're not sure how to invest, the book and everything else recommends you start off with mutual funds. You see little stocks, little bonds, and you see how a portfolio manager basically could manage it. The problem with the mutual fund is you don't see how much of a cut that the portfolio manager is making. How much you see the profitability after his cut or her cut or the firm's cut, but you don't see what that cut the portion is. So it's kind of disfigured. The new laws and regulations are trying to make this more transparent, so you'll be able to see that. Measure investments. A Dow Jones average, S&P, Standard & Poor's 500, Ameritex, NASDAQ. All these are indexes to letting you know if the big companies are doing well, how do the other companies are doing. So if they're having trouble, odds are the junk bonds, everything else may have trouble. But you as a stockholder, you still have to take that investment. And this is what the Dow Jones is telling you, 30 blue chip stocks. And those change over time depending on how the organization been managed. If you look at a lot of organizations now, so some kind of research, are being managed more by women. Even our new Secretary of, what do you call it, Ben Bernanke, when I look at the Treasury Department, the new head of the Treasury Department, Benoxis, is leaving. There'll be a new woman taking over. Seeing a lot of organization looking at women, chief financial manager, just still take risks, but they're taking more of a calculated risk. Men will take that risk and say, I know that, I got that gut feeling. Sometimes the gut feeling is well, but sometimes the force is just nice to have the calculated and the gut feeling working together. And that's where most women, chief financial, are still taking risks, but not to the same value. So you may not have the same high return, but you're not taking the same risk, so you have a better chance of surviving. And online information, you have Yahoo Finance, AOL Money Finance, MSNL Money, Forbes, and Dow Jones. All of these are good financial tools for you to go online to learn about the stock market and finances. Okay, so again, my name is Dr. DrMochocki. This is we're covering Chapter 19 Securities, and this is a series of learning about the introduction to organizational companies or introduction to business. Again, and I'll see you in the next series. I think it's going to be banking, if I'm mistaken. Bye.